Welcome everyone to this week's webinar. My name's Craig Erlam, Senior Market Analyst at OANDA. As you can see on the chart on the screen right now, we've got the economic calendar. This can be found on the OANDA MarketPulse website. That's marketpulse.com, and you can see it on the economic calendar tab there. You'll also find all our in-house analysis on the website as well. As ever, we're just going to look at the events which are relevant for the pairs which we are going to be looking at in detail today. So I'll just highlight a number of these now. And we only really want to look at the higher economic events as well. We don't need to know every in and out about a country, just the ones which are going to be potentially market moving. And you can see on here, I think I've pretty much got them all. If I have missed any, then please do let me know. And like I say, medium to high ones tend to cover pretty much everything that we want to look at. So let's filter these down by this week, and you can probably see that it is a relatively quiet week to some of that have just passed. While it has been a heavy data few weeks and the political landscape hasn't changed, it's still extremely volatile. Markets have been quite choppy, which has been quite interesting. There has been periods of risk aversion, but it seems to be recovering quite quickly. This is quite prevalent in the US equity markets, for example, where we've got the Nasdaq hitting all-time highs. The Dow and the S&P are still shy of that, but it would suggest that sentiment is still coping quite well despite the constant trade war threats. The political landscape is still very volatile, as I say. We don't have to look far to see where that's coming from, and it's not really changed. The Brexit situation continues to be ongoing and unresolved. The latest white paper, should we say, hasn't gone down too well with the vast majority of people, both in the UK and the EU, so there's a lot more work to be done there. The UK Parliament is going into recess, so it may be quiet over the next month or so, although Theresa May and her team will be working in the background, so it's unlikely to go completely quiet on that front. In the US, Trump is the center of all the firestorms over there, whether it be trade wars or anything else, really. It's it all seems to lead back to Trump. He is picking fights with a number of different people right now. Over the weekend, it was Rouhani in Iran. Now, again, from a markets perspective, which is all we're really concerned with right now, this level of uncertainty and this hostility typically isn't very good. And I genuinely believe that were it not for the prospect of a trade war, etc., and were it not for the hostility between the US and Europe, I think markets would be a lot higher. And perhaps this is a short-term sacrifice that Trump is just willing to make in order to get what he believes to be a long-term gain for the US in fairer trade, which I'm not arguing with in the slightest. I think balanced and fair trade is more sustainable. It's the issues that many people have is how you get there, and that is not, when it comes from an investing standpoint, and you want stability, and this kind of hostile back and forth isn't good for it, and the trade wars, of course, only feed into that. We're already seeing signs of inflation in certain areas as a result of tariffs that have already been imposed. We are seeing companies that are unhappy with the way things are unfolding. And we're still very much in the early days. Trump has threatened another $200 billion in tariffs, but he's willing to go slap tariffs on the whole $500 billion of imports that comes from China. So there's no backing down here from anyone, really. That's one of the things that makes this earnings season so interesting, is to see how corporates respond to this. Are they going to risk the wrath of Trump, who has not held back against his critics? Or are they going to remain quiet on that front? I think it's going to be quite interesting, because earnings as a whole, in general, just to give you an overview, are extremely strong. Now, that a lot of that's to do with tax reforms. and the impact that has had. We're seeing around 20+% growth on the bottom line from corporates, but revenue growth is also very strong as well. So it's not just taxes that are driving this. The other thing that's concerning investors right now is the fact that Trump is turning his attention not away from China to an extent onto the Federal Reserve. And many of you may have seen the interview on CNBC late last week where he criticised the Federal Reserve for raising interest rates, suggesting that he will allow them to do it for now, or allow them to do what they think is best for now. This idea of involvement from the from Trump and his colleagues is not what people want to see. The idea of an independent central bank is you have government who focuses on keeping the economy running well through stimulus, through austerity, whatever it believes is necessary, and then the central bank responds in order to try and ensure stability. The Fed already has two mandates: it's price stability and maximum employment. At the moment it's achieving that, but the more stimulus you see, the more need there is for higher interest rates in order to ensure that stability in the long run, because people always assume that the Fed raising rates is more likely to risk a recession. And while higher interest rates can risk recession, no arguments there, low interest rates for a prolonged period of time can also risk a recession, because that leads to imbalances, it leads to poor allocation of money, and it ultimately leads to markets getting overextended and an eventual collapse. And then we do see recessions on the back of that as well. And that's one of the things that the central bank fears, that as well as overly high inflation, because you can imagine that this slow, steady pace of interest rate hikes is a lot easier for the US to adjust to, whereas if the Federal Reserve holds back a little bit longer, 6, maybe 12 months before raising more interest rates further, then there's the more potential for inflation to spike, and that's a lot more difficult to get under control and usually requires more than a 0.25% rate hike, and that can be far more damaging for an economy, which can again trigger recessions, as we've seen on multiple occasions in the past. So that's another thing that's really worrying investors right now. So while we are seeing a lighter economic week, we've had some services and manufacturing PMIs from Europe this morning, same coming from the US with the services PMI and the composite PMI later on this afternoon. It's still a little quiet. We've got IFO from Germany tomorrow, durable goods orders, initial jobless claims on Thursday, GDP on Friday is the key one for me from a US perspective. Especially, we do have some speeches as well, and of course we have the ECB on Thursday also. Now, the ECB on Thursday, personally, I think it's going to be a bit of a non-event, and the main reason for that is that they've already laid out their plans for the next year, so they may be a little bit responsive to the recent economic data, but they've already made it perfectly clear that their plans for the next 12 months are to cut QE in half in September from 30 billion to 15 billion euros a month, run that till December, and then they won't be raising rates until at least the middle of next year. So they've been pretty clear with that. I'm not sure how much more we could hope to get from them at this particular meeting that's going to in any way differ. And for that reason, that's why I think it's going to be a non-event. But I should stress that just because of this, it doesn't necessarily mean we're not going to see volatility, because the ECB, like other central banks, they have a tendency to create volatility in the market intentionally, but also unintentionally. And that's because a lot of traders are looking for the edge, so they're looking for hints that aren't necessarily there. So you can see a lot of volatility in these events, even on the back of a slight change of term from central bankers. With that, we will move on, because, as I say, it has been quiet, and I don't want to just ramble on for the hell of it, especially when we've had a delay starting because of my own technical issues. And I think what we're going to see on the charts this week, and what you'll see from when we go through them over the next 15 minutes or so, is not an enormous amount has changed. And as I said at the start, we have had choppy markets, so we have had some movement, but we haven't seen any major breakouts since the last webinar 2 weeks ago. And therefore, my view in many cases is pretty much the same. We're still seeing consolidation in euro dollar. Now, at the moment, we've kind of had a few higher lows here, but we've had a very clear series of lower highs. I'm interested to see how this is going, because every time we seem to sell, we seem to get bought into slightly higher. If we could see a break back towards these kind of 115s, then for me that would make this start to look like a descending triangle, which would look quite bearish. But if we do see a break above this falling trend line now, which does have 3 points of contact, then I think things could start to look much more bullish, with initially into around these kind of 115s, but I think potentially higher as well. If I'm perfectly honest, I'm slightly swayed. Personally, I slightly have a bearish stance on the US dollar. The simple reason being, and this may come across in all of the analysis I do, the simple reason being that a lot of what the US is doing and a lot of what the US has done is already factored into the markets. I don't see the Federal Reserve making major changes to its policy stance, whereas I do think there is potential for surprise from others. And I think we have seen a correction here in the US dollar, which has brought us, the appreciation of which has brought us back towards these kind of 115 levels. I'm questioning just how much more there is to be priced in. So I'll continue to keep an eye on charts and let the charts guide my views on the currency, but I am curious as to whether this correction has gone as far as it is going to go against a number of these different currencies. And like I say, as you'll have read at the start, this is not in any way advice. This is just my personal view on what we could be seeing for the dollar. I'll see how this plays out. I think we could potentially see a lot more consolidation, yet the summer periods can be typically a little bit quieter. If we look at cable as well, my view is similar, and again, you'll start to see that this does coincide. Yes, we saw some more weakness in the pound. This was primarily driven by the weaker data we saw in the UK last week. We started off with a pretty decent, if not unremarkable, jobs report. It was really the finer components of it which attracted a lot of attention. So things like the unemployment figure remained at I think it was 4.2%. Wage growth was around 2.5%, so wasn't knockout by any stretch of the imagination. We also had the other components of it, which I thought were quite interesting, though, is things like we had highest ever levels of employment in the UK. We've also got the highest number of job openings on record in the UK as well. These type of things tend to point to a tighter labour market. While that's not being reflected in the wages yet, which I do think could be partially Brexit related, it does suggest that the labour market is tightening, and it's these type of indicators which I think the Bank of England are paying very close attention to. However, this was followed on Wednesday and Thursday by CPI and retail sales figures, and both of these were weaker than were expected. And it was interesting, the reason for this. A lot of people have been looking at the UK in the second half of June and the first half of July, seeing the incredible weather we've been having. I should stress, by our own standards, late 20s here for more than 3 or 4 days is what we call a heat wave. And we've now had it for around a month and a bit. So this is some of the best weather we've had in the UK in my lifetime, which is quite sad, really. But at the same time, it's been enjoyable while it's lasting. People have combined this with the World Cup fever that there's been here, the fact that England were actually doing well. There was a lot more people going out to the pubs and to restaurants and to social events and spending money as a result. So people were looking at these as signs that, A, we could see a high level of spending in June and July also, but also that we could see inflation tick up potentially, because if people know that they're going to get large crowds irrespective, then you could see them take advantage of that with higher prices. That wouldn't be necessarily unusual. But and while we did see evidence of that in the bars and restaurants, particularly on the sales side, the complete reverse was true on the shop floor. So instead of seeing higher footfall, we actually saw much lower footfall because people got spending their money in bars and restaurants instead of in the shops, and that led to retailers to apply discounts to try and pull people in. So what we actually had was lower inflation and weaker than expected retail sales growth. So that really hit the pound on Wednesday and Thursday last week. It started to make people question just how strong the economy is and whether the Bank of England really does have fundamental footing to raise interest rates in August. After the jobs report, the Bank of England, a rate hike from the Bank of England was around 80% priced in. That was changed by Thursday evening to around 68%. I haven't looked at it since Friday, if I'm honest, but that was around 68% on Friday. That may have improved slightly in line with the little bump up that we have seen in the pound here. And I think the comments which we've had since from policymakers, for me, I still believe we're going to see a rate hike in August. Not because we necessarily should. I've made my views perfectly clear before. I think the economy is okay. It's better than many anticipated, but it's far from strong, and it's far from as strong as other countries around the world. We are seeing lower levels of investment because of the level of uncertainty because of Brexit. On top of that, I do think the labour shortage is because we are seeing fewer people from the EU coming over here, and some have left. So I think it's artificial labour shortage at this moment in time, and maybe it's the higher levels of job openings is potentially a result of a lack of qualified labour, and I don't think there's a strong desire to necessarily just start paying higher wages in order to fill these roles. The other factor is that the negotiations on Brexit aren't going very well, and while that may improve, and we're hoping to see some outline of a deal between October and December, it's far from clear right now. And I think the last thing the Bank of England wants to be doing right now is raising interest rates just because they feel like they have to, and then having to reverse it later on this year. Problem is the Bank of England's backed itself into a corner because it seemed very intent on raising in May, but then that weak first quarter, rather than putting them on hold, they just wanted to see if the weaker data did filter out, and it did. The data bounced back, but the problem is it's not overly strong either. And I think the Bank of England feels backed into a corner now that feels like it has to raise interest rates. And again, the commentary we've had from the likes of Tenreiro, who spoke last week, talking up the quality of the PMIs while not really addressing other things. We heard from Broadbent since, who said he's not sure how he's going to vote at the next meeting. We only need two policymakers to change their minds and to take it 5-3 in favour of a hike. For me, I still think there is a desire there, albeit one that's not necessarily supported with confidence among a number of policymakers to raise interest rates. And I do think, therefore, they'll follow through and hope that the UK and the EU can get their act together and follow through with an agreement on the UK exit and outline for a future trade deal and save them their blushes. That's my view on it. And if you look at the way the markets are right now, yes, we're trending low, but this is far less steep than it was initially following the drop from around just below 144. We've hit a new low recently, which has fallen in line with this falling channel. But at the same time, we look at the momentum indicators, stochastic making higher lows, MACD moving averages making higher lows, the histogram making higher lows. So this momentum is not really with this move. For me, this is looking a little weak, and I wouldn't be surprised to see a break above that falling channel right now. But again, I must stress, when it comes to Brexit, negative headlines can appear, so be very vigilant about that, because that view could quite easily change. Or if the UK data continues to take a downturn over the next 2 weeks, keep a close eye on what Bank of England policymakers have to say. There hasn't been a massive change yet, and again, like I say, Tenreiro optimistic on PMIs, Broadbent undecided. If more and more policymakers start to come out and question the need to raise interest rates, then people's views on August could change quite quickly, and I'd expect that to be reflected in the chart, both with prices falling, but then also I would expect the momentum indicators to start to support those declines as well. Euro sterling hasn't really changed either. We are gradually climbing, but we're not in a territory yet where it particularly interests me. Yes, we have broken above these previous highs, which was quite interesting, and made a series of higher lows. But in the longer term, we're still in this sideways trend. If we break above 90, then I'll become much more interested in this. But I really wouldn't be surprised if this does just reverse back to the downside again. So I'm not getting too excited by this at this stage. And we are approaching levels where I would be keeping a very close eye on those momentum indicators. Interestingly, at the moment, they are supportive of the rally. So it'll be very interesting to see how we do trade around that 90 level should we get there. But like I say, it continues to be a pair that just doesn't particularly interest me because of how it's been trading for some time now. Aussie dollar could start to look interesting right now because we came back towards these kind of 73.50 levels. We ran into support repeatedly between over the course of the last month, with ultimate support being found just around these kind of 73s. We came up here and peaked around 74.85. coinciding with those previous lows. We've tested the low again, failed at the low again, much lower momentum on that last decline, and now it seems we're edging higher. If we can break above these 74.85s, then suddenly we've got a nice little double bottom on our hand, and it could give us a nice possible price projection higher. Again, from around this kind of 73.25s to 74.85s, that gives us a possible price projection of around 260 pips, so that would take us to 77.45, 77.50. If I'm not mistaken, so that could take us back towards these kinds of levels. Sorry, my bad. 73.25, 74.85. So that takes us back to around the 76.45, 76.50, which takes us back to these kind of levels. That looks much better, coinciding with the previous high and here as well. It would also give us a little bit of a correction once again. So potentially some interesting moves, potential bottom pattern here in the Australian dollar, US dollar pair. Canadian dollar is continuing to climb. We have made a series of higher lows here. Potentially a little fail here at the last time of asking. Later on last week, we've come back and we've tested these lows once again, but we're continuing to hang around these levels. I'm curious as to whether we're going to see a little bit of a breakout to the downside, having already rallied quite strongly. We did find support in this 130, 131 region last time, which didn't come as a surprise, because having broken above that level here, this was highlighted as possible support. We could continue to climb from here, and if we go through these previous highs, then these kind of 135, 50s, 136s become levels of interest. But I'm just wondering if the market's become a little bit cautious at these kinds of levels, having failed in this region on a couple of occasions now, failed to make a new high last time before correcting back. Like I say, first indication could be a break of that trend line, after which a break of 130, that would be a nice little bearish signal indeed. Sterling CAD is looking a little bit soft as well. We did have support here around the 200-233 day simple moving average band. We saw a correction back into the 50 fib, nice little reversal off of there. We're seeing another test of the 200-233. 200 held for a little while before that broke late last week. We came back towards the 233 again. We are consolidating, but this is looking a bit soft for me. If we can see a close below that 233 and break below that previous low, then of course 170.50 becomes a level of interest. But for me, the important break's happened. It looks like it's in the process as it is. I'm just waiting for a little bit more confirmation of that, but that is looking nicely bearish as far as I'm concerned. In terms of what levels we'd need to see to the upside to overcome this, I'd like to see a break above these previous highs. So around above the 174.65s takes us back above the 200-233 moving average band and ends this mini series of lower highs. So I'd like to see a break above these 74.70s, let's call it. And if we see that, then potentially this we are going to see a bit more of a corrective move at this part. But at the moment, that still looks quite bearish for me. So my view hasn't really changed on this one. Kiwi Dollar is similar to Aussie Dollar in a way. Not a perfect double bottom here potentially forming, but still potentially one. I think, again, 68.50 looks quite interesting to me. If we can see a break above there, then that could be a nice little bullish signal in the near term. I do think if you look at the momentum indicators here, yes, we failed to make a lower low, so it's not divergence per se. But when we're approaching a low and the momentum is slipped away to the extent that had, I think the message is very much still the same, that the sellers weren't as convinced selling there as they were on the last occasion, which is typically quite a bullish signal. And also a break above these kind of 68.50s takes us through this previous area of support, which has already been resistance on this occasion. So I think that could be a nice little bullish signal if we can see a breakthrough there. But I wouldn't be surprised also if we see a bit of consolidation first. For example, if we saw a reversal off 68.50 and a new higher low, then we'd have a kind of rising triangle, which again would be a bullish signal following a breakout. But again, consolidation in the meantime wouldn't come as a huge surprise. Dollar yen is continuing to look relatively bullish. I've got this rising trend line on here, which I'm paying very close attention to. This zone around 110.85, 111.50 is particularly of interest. You may wonder why I've seen such a sharp sell-off in this pair over the course of the last week, and it seems to have a lot to do with the Bank of Japan. There's a lot of growing speculation right now that the Bank of Japan is looking to amend its bond buying program. Now, there's different rumors about how they're looking to do that. The underlying belief based on the speculation seems to be that the Bank of Japan is looking to find a way to ultimately remove its reliance on having to buy X amount of bonds every month. At the same time, remaining committed to doing so if needs be, and also at the same time, potentially, again, all speculation at this stage and nothing that's been acknowledged by central bankers themselves, potentially raise the yield that it's aiming for on the Japanese 10-year. So the central bank policy for some time now has been keeping the Japanese 10-year at or around 0%. The speculation that it could rise to, for example, 0.01%, which doesn't really sound like much, but from a market's perspective, it suggests that it's a slight removal of the extraordinary loosening that we've seen from the Bank of Japan for some time. Potentially an acknowledgement that inflation is gradually improving, and again removing the necessity for the central bank to continue purchases at the current levels. It doesn't sound like much, but we have seen quite an appreciation in the yen on the back of that. If we do see a break below these kind of 110.80s, below that trend line, below previous support, then potentially this is a sign that the market really is buying into it. As far as I'm concerned, 109 starts to look very interesting for me here. 109 again is prior support at these levels here, but at that point now, that's when 109, 110 is when we're starting to see a test from a price action perspective of the cloud and of these moving averages as well, and a breakthrough there could be a very bearish signal. I'm just struggling to see right now see that happening purely based on a speculation. I think we'd have to either see a reversal in the dollar, which I guess, as I said earlier, wouldn't come as a major surprise to me given the view I have on other things, or a confirmation for the Bank of Japan. It's the latter that I'm really not expecting. Again, this is one where I'm going to continue to watch the charts, but as I say, a break of these kind of 110.85s, then this kind of 109, 110 area starts to become very interesting as far as I'm concerned. We're still some way from getting confirmation from the lagging line here, so we're very much focused on price action around that Ichimoku cloud. Sterling yen, on the other hand, never came close to moving above the cloud from a lagging line perspective, never got that confirmation. We are trading back below, having briefly popped above. I don't really hold a particularly strong view on this at this moment in time. Again, the yen was strong on the back of that speculation, but at the moment it seems to be a bit of a battle overall of two currencies which aren't particularly strong. So we are seeing a lot of choppiness, sideways trading. Higher lows here, higher highs here, but that could quite easily be a consolidating pattern. I'm not reading anything too bullish into it. If we can break above that 150 level, for example, then things start to look a lot more interesting. But we're far from that at this point. We're just below 146. Of course, a break below the kind of 143.75, 143 zone, then things start to look a lot more negative again. But I'm not even particularly convinced that we're going to see that either, to be quite honest. Unless, of course, again, Bank of Japan confirms it, or we see a big change from the UK, be it central bank or Brexit related movements. For example, if the Bank of England came out in August and said we haven't raised rates, and moreover we're probably not going to do it for a while now because the economy has softened and we want to see how Brexit plays out, then of course that would be sterling negative, and that changes this altogether. Euro yen, again, is quite interesting right now because we did break above here from a price action perspective. We did have some momentum behind the move. We have seen a corrective move off the 200 to 33-day simple moving average band in between the 50 and 61.8 fibs. Coming back towards these kind of 130 levels, all of a sudden we are running into support, but also we ran into resistance as well where the Ichimoku, where the lagging line meets the cloud. I think there's potential here for this to break back through the cloud, both the lagging line. So if we see an upturn off these kind of 130s, then and back through the cloud, then I think this starts to look a lot more bullish. Again, though, it really does depend on how those rumours do play out from a Bank of Japan perspective. Yes, the euro is looking a little bit softer right now in terms of the economy. That said, the ECB is clearly following through with its policy, which is one of the things which has supported the euro. I think this is looking a little bit more bullish for me. Of course, if we do see a break back below the 130s, then you could see these kind of next levels coming under pressure. This is a speculative trend line at the moment, so don't pay too much attention to that. The kind of 128.50s could become of interest, and again, the Ichimoku cloud once again becomes of interest. This is, like I said, when this is looking bullish, we haven't had the confirmation yet, so we're just working off early signs. But at the moment, for me, this is looking quite nice, and I would be surprised if we don't at least see another run up here towards the 132s, if I'm perfectly honest. Okay, that's all we've got time for. Thank you very much for joining, everyone. If you've got any questions, please don't hesitate to reach out to me. You can catch me on Twitter. My username is Craig_Forex. And like I say, any questions, please let me know. You'll find a recording of this on the MarketPulse website later on today and also on YouTube. Finally, there will not be another webinar in 2 weeks' time. The next one will probably be mid-September, main reason being that I'm expecting my first child in just over 2 weeks' time, so not the best time to be planning webinars where I would inevitably have to let people down. So thank you very much, Joseph. So rather than do that, I've decided to hold off over the summer when it's more likely to be quieter anyway, and then we will resume them in September. So please do keep an eye out on your emails. We're hoping to move them to a weekly basis. Thank you very much, Clifton. We are hoping to move them to a weekly basis then on in, so that we can, thank you very much, Share, when we can, I hope you have pronounced your name correctly there. We are hoping to move them to a weekly basis then, so we can provide a more up-to-date rolling, thank you very much, Camillo, update. But until then, I wish you all the very, very best with your trading. I hope you all have a fantastic summer. And for those of you in the UK, I really hope this heat wave continues so we can all stay in, we can all enjoy the barbecues and whatnot for a little bit longer. But apart from that, thank you very much, everyone, for joining again. Thank you, Carol, Stephen, and I will catch you all again very soon. See you soon.